Welcome back to Weekly. I'm chatting real estate with Andrew Moffs of Vision Capital. Let's continue on with the U.S. real estate market, Andrew. Clearly, you like it a lot more than the Canadian market. We're still early in 16, entering Q2. What are a few themes or trends that you're watching in U.S. real estate this year?
Right. So one important theme, it's not particular to this year, but it's carried on into this year, is the growth of the millennial cohort and their propensity to rent. You see 66 million Americans that are renting. This is a big change. 20 years ago, there was the rise in home ownership. Today, they want to live in apartments. They want to live, work, play close to close in urban centers.
So you're saying that 66 million is a lot higher than it would have been 15 years ago?
Greater than the baby boomers.
Really?
So if you look at this cohort, they don't have driver's licenses. They care about walkability scores, how close are they to Starbucks and to their office building. We like apartments for that reason. Equity Residential is a great example of that. So is Camden, as I mentioned.
Equity Residential? Is that Sam Zell's company?
Correct. It's the largest operator of apartments across the United States, focused really on 5 major urban markets.
Now, when you look at the millennials and renting, am I correct that not a lot of apartment buildings got built in the States over the last 10 years, let's call it, and as a result, there's a bit of a supply-demand imbalance, which is one of the reasons that you like apartments, because you see rate hikes?
Correct.
Or rent hikes, not rate hikes.
Absolutely. I mean, the markets are concerned that supply is increasing. Right. It's nowhere near the demand that is coming online. The silver lining of the great financial crisis was we went into a downturn in real estate where we didn't have new supply come to the market. It's only now that we're several years into the recovery.
Did that have to do with rent controls, or why did nobody build apartments in the States?
No, it has everything to do with the lack of financing. Developers went away. Those that were overexposed into the financial crisis are not in business today.
Interesting. What else do you see in the States this year?
One very important theme is the implementation of real estate as the 11th industry under the GICS sectors. S&P, the global industry classification system. Previously, REITs had been grouped under financials.
Right.
So now today, we do our math and we see that with real estate becoming its own asset class, generalists are underweight. That could provide over $100 billion US into REITs.
Right. So if I run a mutual fund and I've got my benchmark being the index, yep. Well, let's say financials have a 12% weight in the S&P 500. Within that 12%, which I benchmark myself against, yep. I may choose to have no real estate and be long bank stocks instead.
Correct.
So now real estate's being pulled out. It's a separate category, yep. And folks are going to have to own real estate.
Yes.
Or make an active decision not to.
Or give a reason to their boards why their attribution was negative for real estate.
So any idea what kind of weight in the S&P 500 that equals 100% real estate could have?
Well, the easier math to do is to say perhaps generalists have a 2.5% weighting to real estate. That should be closer to 4%. And that's where I come up with my $100 billion of inflows, at 12% of the U.S. market cap.
And when's that kick in again?
August 31st of
Interesting.
this year.
What else is going on down there?
A big change, and it's significant for Canadians, is the changes in FIRPTA, the Foreign Investment Tax Act in the United States. Previously, foreign pensions were limited to 49.9%. Otherwise, they'd be subject to onerous taxes when they sold their real estate in the U.S. That's been lifted. So that provides a further floor to the private market values, and why we love public companies like SL Green, the largest office landlord in Manhattan. They trade at such a 25% discount to NAV, and now with the incremental buyer already, who are the biggest buyers of real estate of Manhattan office? The Japanese, Chinese, and Canadians. Now they can double their investment. I think it's great for SL Green.
Now we talked about cap rates being the inverse of the price to cash flow multiple earlier. And of course, cap rates have gone down a lot as interest rates have gone down to zero and now negative in some countries. But can cap rates keep going lower if interest rates stay lower for longer? I mean, is there a floor for a cap rate? And if there is, what drives that floor?
We believe cap rates have compressed and they have bottomed. You have to distinguish, of course, asset by asset class, and we focus more on the capital expenditures, to your point, of what needs to be expended for that first year cap rate. So you might be quoted a 7 cap for a hotel, but really you have to deduct major expenses. Your turnovers nightly in hotels, that could turn into something more like a 5 cap.
Right. Okay. Now let's bring it back home to Canada. What do you see going on in Canada, geographically speaking, sector-wise? trends within real estate?
Right, you really have to go geography by geography and sector by sector. We're very positive on senior housing fundamentals here in Canada.
Across the country?
Across the country.
Right.
There's been a great recovery. You talk about demographics, the aging senior population, and then you also talk about capital inflows. This sector is starting to get bids from the private market. You look at the Chartwell Retirement Residences, that's the #1 operator, biggest operator in Canada. We own that stock for the reason that the implied cap rate in the high 6 makes no sense in this market. Institutions view this asset class more and more like apartments.
What about Western Canada?
Western Canada is certainly challenging, and that's obviously an understatement.
And I'm moving along from senior housing. I'm just going geographically when I say Western Canada.
And I understood. I think when we look at across the country, we are underweight office, we're short office, and that's because of an oversupply. And if you look specifically at Western Canada, Calgary and Edmonton, before the fall off in oil, we were already short stocks over there. Why? Because the supply, you had 5 million square feet coming online in Calgary.
Right.
And you juxtapose that in Toronto, where the economy is better, still, you have 7 million square feet coming online. That's a lot for the market to absorb.
Now, being short something like Dream Office has been a good cow to milk over the last year and a half. Is there still juice left in that cow?
What's interesting about Dream Office is, and we find this not particular to Dream Office, but pretty much any office REIT in Canada and the analysts, there's too much of a focus on what I call gross rents. We keep hearing rents are $18, don't worry, we can still get $19 today.
That's that headline advertise rate.
Absolutely.
Right, okay.
Very quickly, an $18 rent can turn into a 10, can turn into 0, as soon as you start including things like tenant inducements and free rent. We hear cases of in Edmonton, net effective rents are 0. Basically,
Really?
landlords are asking tenants, please come in here, cover our operating costs. That's not factored into the net asset value equation of Dream Office today. One issue, net asset values are backward looking. There's no trades. We don't know cap rates today in Alberta. And even if we did, we don't know NOI. To my point, when you do NOI being the net operating income, when you start factoring net effective rents, net asset value for something like Dream Office is nowhere near the high 20s number that the analyst consensus is today.
Interesting. And very last question with respect to internet and retail and shopping malls. Are there winners and losers from the structural shift in retail spending towards the internet?
Absolutely. Two things I'd make. There's haves and have-nots. The Class A malls will continue to be dominant. You look at Yorkdale doing over $1,600 per square foot in sales. You look at the Class B malls; those will be dodo birds. How do we take advantage of this? We own the Class A malls in the United States. We own a company called Macerich, an S&P 500 company, finest assets. We think industrial is the new retail. What do I mean by that? E-commerce is what is taking the wind away from retail sales. And when we look at industrial, that is simply inventory restocking. Every 1 unit of demand for something in e-commerce requires 3 units of inventory warehouse space.
Interesting. Thanks very much, Andrew.
Thank you.
I've been chatting real estate with Andrew Moffs of Vision Capital. Please stay tuned. After the break, I'll tell you what you need to watch for in the markets next week. And of course, viewer email.